The stock market is often portrayed as a realm of opportunity, where careful analysis and smart decisions lead to wealth and financial security. Yet beneath the surface lies a hidden world where unscrupulous individuals exploit systems, manipulate prices, and deceive unsuspecting investors. Stock market scams are not always blatant. Many are executed with precision, making them difficult for the average investor to detect. From subtle misinformation campaigns to sophisticated schemes involving multiple layers of deception, these tactics prey on trust, greed, and the hope of quick gains. Everyday investors, focused on following trends or chasing profits, may remain oblivious to the calculated maneuvers occurring behind the scenes. Understanding this hidden landscape is essential, not only to protect one's investments but also to recognize the broader impact of manipulation on the market's integrity. In the sections that follow, we will explore the techniques scammers use, the psychology they exploit, and the consequences that can ripple through both individual lives and global financial systems. Investors often believe that their financial decisions are guided by logic and careful analysis, yet psychological factors can leave them highly vulnerable to scams. Greed, the desire for quick wealth, frequently clouds judgment, prompting individuals to take risks they might otherwise avoid. Similarly, the fear of missing out, or FOMO, drives investors to follow trends without fully evaluating potential consequences, making them easy targets for artificially inflated stock schemes. Herd mentality amplifies this effect, as people often mirror the actions of others, assuming that mass participation signals safety or opportunity. Overconfidence in one's market knowledge can further blind investors to red flags, causing them to underestimate the sophistication of manipulative tactics. Historical examples, such as the infamous Ponzi scheme orchestrated by Charles Ponzi in the 1920s, demonstrate how scammers exploit these psychological tendencies. By presenting the illusion of guaranteed returns and mass participation, they manipulate emotions to secure trust and investment, often leaving victims devastated once the deception unravels. Pump and dump schemes are among the most notorious forms of stock market manipulation, designed to exploit the enthusiasm and trust of everyday investors. The process begins with scammers identifying low-value, thinly traded stocks, often penny stocks that are easy to manipulate due to limited liquidity. Promoters then artificially inflate the stock's perceived value, or pump it, through a combination of tactics designed to generate hype and excitement. This can include spreading fake news articles, issuing misleading press releases, posting exaggerated claims on social media platforms, and even creating fraudulent analyst reports to suggest a stock is a hidden gem. As excitement grows, more investors are drawn in, motivated by fear of missing out or the belief that the stock is poised for legitimate gains. Meanwhile, the perpetrators quietly sell off their own shares at the inflated price, reaping massive profits. This dumping leaves ordinary investors holding overpriced, overhyped shares that often plummet in value once the manipulation ceases. Notable historical examples include the 1990s penny stock craze, where unscrupulous brokers used cold-calling campaigns and newsletters to pump small companies before selling off. More recently, certain meme stock surges have shown modern variations of pump-and-dump tactics, demonstrating that despite regulatory oversight, these schemes continue to evolve and exploit investor psychology. Insider trading occurs when individuals with access to confidential, non-public information about a company use it to make trades for personal gain, giving them an unfair advantage over ordinary investors. This practice undermines the integrity of financial markets, eroding trust and creating an uneven playing field. Insider trading can involve corporate executives, employees, or anyone privy to critical information, such as upcoming mergers, earnings reports, or product launches. By acting on knowledge unavailable to the public, these individuals can secure significant profits or avoid substantial losses while other investors remain unaware of the true market potential. Legal consequences for insider trading are severe, including hefty fines, disgorgement of profits, and imprisonment. High-profile cases, such as the conviction of Martha Stewart for trading based on non-public information, and the numerous prosecutions during the 1980s Wall Street scandals, have shaped modern regulations and enforcement practices. Regulatory bodies like the SEC actively monitor trading activity to detect and punish such violations, aiming to maintain fairness and confidence in the markets. High-frequency trading, HFT, uses advanced algorithms and superfast computers to execute trades in fractions of a second, giving large firms a significant advantage over ordinary investors. These systems can analyze market conditions, detect trends, and react to price movements far faster than any human trader. While HFT can provide liquidity and efficiency, it can also be exploited for manipulative purposes. Techniques such as spoofing, where traders place large fake orders to create the illusion of demand or supply, or layering, which involves submitting multiple orders to mislead other participants about market interest, are common tactics. Once the market reacts, the manipulator cancels the orders and profits from price shifts. Retail investors, operating on slower systems and relying on conventional strategies, are often left disadvantaged, buying or selling at manipulated prices. Regulatory bodies like the SEC have increasingly scrutinized these practices to maintain fair trading conditions. Ponzi schemes are one of the most notorious forms of investment fraud, built on the illusion of steady, high returns with little to no risk. Instead of generating real profits, scammers use money from new investors to pay earlier ones, creating the appearance of a successful enterprise. This cycle continues only as long as fresh funds flow in, but inevitably collapses when recruitment slows or too many investors demand withdrawals. Scammers often build credibility by flaunting wealth, leveraging personal connections, or presenting fake account statements to gain trust. Bernie Madoff's infamous $65 billion Ponzi scheme remains the largest in history, where thousands of investors, including charities and celebrities, were defrauded for decades. Victims are often lured by promises of exclusivity, insider access, and guaranteed returns, offers that seem too good to be true but exploit human hope and greed. Ponzi schemes highlight how false confidence can devastate lives and savings. Social media has transformed stock trading into a fast-moving, viral environment where hype can move markets within hours. Platforms like Twitter, Reddit, and Telegram give ordinary users the power to influence stock prices by collectively promoting specific companies, sometimes with genuine enthusiasm and other times with deceptive intent. While the rise of meme stocks like GameStop and AMC showed the strength of online communities rallying against Wall Street short sellers, the same channels can also be exploited by scammers. Fake news, exaggerated claims, or coordinated campaigns can artificially inflate demand for certain stocks, creating a modern version of the pump-and-dump scheme. The blurred line between enthusiastic investment chatter and deliberate manipulation makes it hard for regulators to intervene. For everyday investors, this new dynamic presents both opportunities and risks, as social media can empower them but also leave them vulnerable to orchestrated fraud. Regulatory loopholes and weak oversight create fertile ground for stock market scams to thrive. While laws exist to prevent manipulation, enforcement often lags behind the speed and complexity of modern financial schemes. Scammers exploit gray areas where activities may be unethical but not explicitly illegal, such as spreading opinions online that function as disguised investment advice. International markets add another layer of complexity, as enforcement standards vary widely between countries, allowing fraudsters to operate across borders with minimal accountability. For example, a scheme shut down in one jurisdiction might continue unchecked in another with weaker oversight. Additionally, limited resources at regulatory bodies mean that only the largest or most publicized cases are pursued, leaving many smaller scams undetected. These gaps give manipulators room to operate confidently, knowing that the likelihood of being caught or punished is low compared to the potential profits. Spotting stock scams requires vigilance and a healthy dose of skepticism. One major red flag is the promise of guaranteed returns, or profits that seem too good to be true. No legitimate investment is risk-free. Investors should also be cautious of tips coming from unknown sources, whether through emails, social media, or online forums, especially if they pressure you to act quickly. Abnormal trading patterns, such as sudden unexplained spikes in price or volume, can signal a pump-and-dump scheme. Verifying information through reliable sources, like official company filings and trusted financial news outlets, is essential before making decisions. Another sign to watch for is a lack of transparency, such as companies with vague business models, incomplete financial disclosures, or unverified claims about partnerships and breakthroughs. By learning to recognize these patterns, investors can avoid falling prey to scams and protect their financial well-being. The victims of stock scams often endure far more than financial losses. They face emotional devastation and shattered trust. For many, life savings vanish overnight, leaving families unable to pay for education, retirement, or even basic needs. Elderly investors, who are frequently targeted, may never recover financially, forcing them into hardship after decades of careful planning. Beyond money, the psychological toll is immense. Victims experience shame, guilt, and a deep sense of betrayal, which can strain relationships and erode mental health. One example is the collapse of Bernie Madoff's Ponzi scheme, which wiped out the fortunes of thousands, driving some to depression and even suicide. These stories underscore that scams aren't victimless crimes, they leave scars that last a lifetime. Understanding this human cost adds urgency to efforts for stronger protections, education, and vigilance in the fight against stock market fraud. Financial institutions and regulators are increasingly relying on technology to fight back against stock market scammers. Artificial intelligence, AI, and machine learning systems can analyze millions of trades in real time, flagging suspicious patterns such as sudden price spikes or coordinated buying and selling. Blockchain technology offers transparency and traceability, making it harder for fraudsters to hide behind fake transactions or shell accounts. Advanced monitoring systems now track social media chatter, scanning for signs of pump-and-dump schemes or viral misinformation before it spirals out of control. Regulators also use big data analytics to connect the dots between seemingly unrelated activities, exposing networks of fraudsters that operate across borders. While scammers constantly adapt, these technological defenses are evolving just as quickly, creating a digital arms race. The ongoing battle shows that protecting investors requires both innovation and vigilance, as no system is completely immune to manipulation. Avoiding stock market scams ultimately comes down to staying vigilant and informed. While scammers continue to invent new tactics, their success still depends on exploiting human emotions like greed and fear. Investors who take the time to educate themselves, verify information from credible sources, and question promises that sound too good to be true are far less likely to fall victim. Awareness of red flags, such as guaranteed returns, pressure to act quickly, or suspicious trading activity, can serve as a powerful shield. Equally important is staying updated on how markets evolve, as new technologies and platforms often create fresh opportunities for manipulation. By combining critical thinking with careful research, investors can protect not only their finances but also their peace of mind. In a world where fraud never disappears, knowledge and vigilance remain the strongest tools for safeguarding wealth and building lasting financial security.